Listen carefully. The prevailing narrative in the financial world paints index funds as the ultimate sanctuary, a reliable set-it-and-forget-it solution for building long-term wealth. They are often championed as the safest harbor in the often stormy seas of the market. But what if this widely accepted wisdom, this comforting certainty, harbors a critical blind spot? What if there's a singular, often overlooked cost that can quietly, yet devastatingly, decimate your hard-earned wealth over decades? Benjamin Graham, the father of value investing, once stated, "The investor's chief problem, and even his worst enemy, is likely to be himself." This profound truth resonates deeply as we explore a systemic cost, amplified by our own inherent behavioral tendencies, that can undermine the very long-term wealth that index funds are supposed to deliver. We are conditioned to believe in the passive perfection of indexes, but this video is here to gently, yet critically, challenge that myth. We're going to dissect the singular, hidden cost that mainstream discussions on index funds often gloss over. It's a cost that doesn't appear on your brokerage statement in bold numbers, but its impact can be insidious, silently eroding returns over time and potentially decimating your financial future. This isn't about demonizing index funds, but about understanding them with a clarity that goes beyond the surface. Prepare to question the true definition of passive investing. We will uncover the subtle yet significant drag on your portfolio, a drag that many investors remain blissfully unaware of. Our journey together will arm you with the data-driven insight necessary to counteract this insidious wealth destroyer. The goal here is not to sell you on a different product, but to equip you with a profound understanding of market mechanics, a deeper wisdom that transcends the noise. This understanding will enable you to make truly informed, strategic decisions, paving the way for sustainable wealth accumulation, not just for today, but for generations to come. The core issue with index funds, despite their widespread appeal, lies in their very design. They are engineered to mirror an index, to be a faithful reflection of a specific market segment. However, this mirroring is never perfect. An inherent, unavoidable reality is tracking error, the deviation between the fund's performance and its benchmark. This isn't just a minor statistical anomaly. It's a consistent, compounding drag that subtly erodes your returns. Think of it as a runner tasked with perfectly matching the pace of the fastest athlete in the world. Even a slight, persistent lag in every single stride, compounded over thousands of miles and countless races, means you will never quite reach the finish line at the same time. In fact, you might even fall behind those who aren't attempting to mirror anyone at all, but are simply running their own race. And let's address the persistent myth of no fees. While index fund expense ratios are often commendably low, they are still fees. More critically, however, is the profound opportunity cost associated with not capturing true alpha, or even just matching the index perfectly. This represents a significant, often unacknowledged, hidden expense. We must quantify this lost alpha over the long arc of 30 or 40 years. Consider a hypothetical $10,000 investment. When we examine historical tracking errors across major index funds, like those tracking the S&P 500, and calculate the cumulative impact over 3 decades, the difference becomes stark. This is compared not just to a perfectly tracked benchmark, but to a strategy that possesses genuine alpha potential. The hidden cost is revealed not merely in the expense ratio, but in the sum of management fees, trading costs, and the inherent inefficiency of always striving to be merely average. This consistent, silent erosion is the singular hidden cost that can truly decimate your long-term wealth. The allure of index funds is deeply psychological, isn't it? Their simplicity and the promise of perceived safety appeal directly to our innate desire for control and our profound need to avoid risk. This cognitive comfort, this feeling of being on solid ground, paradoxically makes us less likely to scrutinize the subtle, persistent inefficiencies that inevitably plague their performance. It's a comfort zone that actively discourages the critical analysis required to identify the slow bleed of tracking error and other implicit costs. This creates a significant blind spot, a blind spot that allows a silent erosion to take hold. This allure of passive investing taps directly into our innate desire for low effort and minimal stress. We crave an investment strategy that requires little active management, a strategy that seems to run on autopilot. But this very comfort, this desire for ease, can mask a dangerous trap. It discourages the very critical thinking needed to uncover the subtle drains on our capital. Then there's the anchoring bias effect. We become fixated on the low expense ratios and the broad promise of diversification, often ignoring the cumulative impact of small deviations, the tiny lags that, over time, become substantial. It's akin to focusing on a minuscule speck of dust on a vast, beautiful canvas, while completely overlooking the larger, more significant imperfections that mar the overall picture. To actively counter this bias, we must commit to regularly reviewing fund performance against its exact benchmark, not just general market movements. We must also strive to understand the mechanics of ETF creation and redemption, processes that can profoundly influence tracking accuracy. Settling for good enough, that is, imperfectly matching the index when superior returns are theoretically achievable, whether through informed active management or truly efficient passive strategies, is the behavioral trap. It is this trap that allows the hidden cost to silently, yet relentlessly, decimate your wealth. The concept of diversification, while essential for mitigating specific risks, carries its own subtle cost. It dilutes any potential for outperformance. Index funds, by their very nature, are designed to be average. They aim to capture market-level returns, and in doing so, they inherently sacrifice the possibility of achieving alpha, that elusive outperformance over the benchmark. It's a fundamental trade-off that is often overlooked in the simplistic narrative of passive investing. Consider this metaphor. Imagine a master chef who believes the ultimate culinary creation is achieved by mixing all available ingredients into one single homogeneous paste. While you might get a bit of every flavor in each spoonful, you inevitably lose the distinct character of each component, the nuanced interplay of tastes, and the potential for true culinary excellence. Index funds, in this analogy, represent the bland paste of the investment world. They offer breadth but lack depth, a vast exposure that smooths out the peaks and valleys, but also caps the potential for soaring highs. The true strategic cost, therefore, is not merely the expense ratio or the minor tracking errors we've discussed. It is the profound surrender of potential alpha. By consciously choosing to be average, you forego opportunities to capitalize on mispriced assets, to exploit market inefficiencies, or to ride the wave of sector-specific growth that a more discerning, strategically focused approach might capture. This isn't about reckless speculation. It's about informed decision-making, exploring how a focused, data-informed approach, whether it's rigorous value investing, factor-based strategies with robust backtesting, or even select active management with proven, demonstrable track records, can systematically offer a higher probability of outperforming over the long term. Such strategies can, in effect, offset or even exceed the hidden cost of index fund mediocrity. Ultimately, it's a conscious decision between the certainty of market-level returns, with all their inherent inefficiencies, and the potential for superior returns through strategic, informed decision-making. While the latter path may involve a different set of risks, it crucially avoids the silent decimation that comes from embracing mediocrity. Let's put a number on this decimation. We need to move beyond abstract concepts and look at the tangible impact of mediocrity. Consider the average tracking error of a major ETF like SPY or VOO combined with its expense ratio. Now, let's project this over 30, 40, and even 50 years. This isn't about predicting the future with absolute certainty, but about illustrating the undeniable principle of compounding drag. The power of compound interest, a force we often celebrate, works relentlessly both for us and against us. The hidden cost of index funds, in essence, is a negative compound interest effect. Small deviations, minor fees, and slight inefficiencies are not static figures. They are magnified exponentially over time. Imagine a visual representation of this divergence. Two lines on a graph, one steadily climbing, the other lagging, the gap between them widening with each passing year. Let's consider a real-world impact. Picture a $10,000 initial investment. Assume an annual return of 8%. Now, compare two scenarios, one in a perfectly tracked index and another in a typical index fund with, say, a 0.05% expense ratio and a 0.02% tracking error. The difference in the final portfolio value after decades can be truly staggering, potentially tens, if not hundreds, of thousands of dollars. This is the compounding power of what we might call imperfect average. So, how do we actively mitigate this cost? It begins with a diligent scrutiny of fund prospectuses, seeking out explicit tracking error disclosures. It involves considering lower-cost institutional share classes if they are accessible, and most importantly, understanding precisely when the trade-off for achieving perfect average is no longer worth a potential sacrifice. The decimation we speak of is not a sudden, dramatic loss, but a gradual, persistent starvation of potential returns. This slow bleed, amplified by the relentless force of compounding, is the singular, devastating cost that truly intelligent investors must understand and actively counteract. It is the enemy within the seemingly safe harbor. The path to true financial mastery isn't about blindly accepting popular strategies. It's about understanding their subtle costs and deploying data-driven insights to build sustainable wealth. It's about ensuring your investments work for you, not just with the average. This means moving beyond passive acceptance of index funds and understanding their inherent limitations. The goal isn't necessarily to abandon them entirely, but to strategically employ methods that can overcome their inherent inefficiencies and hidden costs. Think of it this way. If index funds represent a reliable, albeit slow-moving, river, then informed strategies are about learning to navigate its currents, perhaps even harnessing them for greater speed and directness, rather than simply floating along passively. It's about taking the helm. So, what are these practical hedges? We can explore strategies such as actively managed ETFs that demonstrate a proven track record of low tracking error and genuine alpha generation. Consider tactical asset allocation, a dynamic approach that can skillfully exploit market dislocations and opportunities. There's also the power of concentrated, high-conviction value investments, where deep analysis identifies truly undervalued gaps. Furthermore, dividend growth strategies can provide a powerful compounding tailwind, turning income into accelerated wealth accumulation. Crucially, these strategies are not about guesswork. They demand rigorous analysis, a deep, almost intimate understanding of intrinsic value, and a steadfast willingness to deviate from the herd. These are precisely the skills we champion here. True financial independence is built not on the safety of the average, but on the informed pursuit of excellence. It's about understanding the subtle erosion of mediocrity and actively choosing a path that ensures your capital works harder, smarter, and more effectively for your long-term prosperity. Listen carefully. We have journeyed beyond the comforting narrative of passive investing to uncover a critical truth: the singular hidden cost lurking within index funds. It is the silent decimation caused by imperfect tracking, the inherent inefficiencies woven into their very fabric, and the profound surrender of potential alpha. This insidious erosion, often amplified by our own deeply ingrained behavioral biases, can significantly diminish your long-term wealth. Warren Buffett, a titan of informed investing, offered us two simple yet profound rules. Rule No. 1. Never lose money. Rule No. 2. Never forget Rule No. 1. Understanding and actively mitigating these hidden costs is not merely a suggestion. It is paramount to the preservation and growth of your capital. To ignore them is to invite a slow, steady bleed that can ultimately undermine your financial future. This knowledge, however, is not intended to instill fear. Instead, it is a catalyst for empowerment. Armed with this critical insight, you are now better equipped to critically assess your current investment holdings. You can begin to explore more strategic avenues for wealth accumulation, avenues that align with a deeper understanding of market mechanics and a commitment to genuine financial advantage. Our journey together is far from over. We will continue to dissect the intricate complexities of the market, revealing the data, the historical patterns, and the time-tested strategies that lead to truly informed, independent investment decisions. We are dedicated to equipping you with the tools to move beyond the superficial and grasp the underlying truths that govern sustainable wealth creation. The pursuit of true, sustainable wealth requires more than just capital. It demands vigilance, a relentless spirit of critical thinking, and an unwavering commitment to understanding the true mechanics of the market. It is about moving beyond the comfort of the average, acknowledging its inherent limitations, and embracing the power of informed advantage. The question now, for each of you, is how will you leverage this understanding to build your own path to lasting prosperity?